So for those of you that don't know, yesterday the European Central Bank announced that they were cutting the base rate. And so the question that I'm getting asked is, what impact is this going to have on the Bank of England's next interest rate decision later on in June? So first of all, let's just take a look at this news article that talks about the decision that was made yesterday. So as you can see, European Central Bank cuts interest rates for the first time since 2019. The European Central Bank on Thursday confirmed a widely anticipated reduction in its interest rates at its meeting, despite lingering inflationary pressures in the 20-nation Eurozone. It takes the central bank's key rate to 3.75, down from a record 4% where it's been sat since September 2023. The ECB Governing Council said in a statement, based on an updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission, it is now appropriate to moderate the degree of monetary policy restriction after 9 months of holding rates steady. So for those people that are in Europe with a mortgage, and if you are on a tracker rate or if you're on a variable rate, this is good news because it potentially now means that your rate is going to drop, your payments will drop, and so that's going to take off a little bit of pressure on the household expenses. But what does this mean for the next Bank of England base rate decision? So of course, historically, the UK have never really moved their interest rate first. They've always waited for the European Central Bank and for the Federal Reserve in America. After their decisions, they've then generally gone on to follow suit on many occasions. However, in America, the Federal Reserve, there's talk that they may not be shifting their rates yet. But now the European Central Bank have cut their rate, there is a strong possibility that the Bank of England could do the same at the next meeting. However, there's a small elephant in the room that might be in the way, and that is the general election. So up until the general election was announced, it was widely expected that we would see a cut from the Bank of England in June, because we also were expecting that the ECB were going to do the same, and we thought that the Bank of England would follow. However, when the Rishi Sunak announced the general election, that kind of scuppered the hopes that we might see that reduction in June and that it might be put back until August or maybe even later on in the year. But following this decision yesterday, that possible rate cut is back on the cards. But let's just have a quick look at what it did to the swap rates. So a quick reminder for those of you that are new to the channel, the top column here shows what the swap rate did from the close of business the previous day. Now this swap rate chart that we're looking at is from the close of business yesterday. So yesterday, the swap rates finished lower than they did when they closed business on Wednesday evening. Hopefully that makes sense. Stay with me. Now down here, we can choose which term of swap rate we want to look at. I typically tend to focus on the 2-year, 3-year and 5-year because these have a direct correlation to the mortgage rates that we see from lenders, and the 2-year, 3-year and 5-year are the most popular fixed rates that people choose from mortgage lenders. Now, of course, this chart goes right back to December 2022, where you can see what the swap rates were at that point in time. And obviously they've gone up and then come back down, then they went back up again a little bit. And now the key thing is here, right at the end, you can see that they closed yesterday back on that downward trajectory, which is good news. Now, if we scroll down a little bit, we can see here previous dates and then again what the swap rate was on those previous dates. So you can see that the 2-year at 4.567 is now heading back to where it was around about March time. The 3-year, the same, is heading back to where it was around about March time. And the 5-year has now dipped back below the 4% again. And again, the last time it was there was in the end of March. So what does this mean for mortgage rates? Well, over recent weeks, we have started to see quite a lot of fluctuation from lenders. Some have been putting their rates up, some have been putting them down. I would say that the more consistent direction has been up. Now, if you don't follow me on Instagram, I would suggest that you probably go do so, because when lenders announce their rate reductions, I automatically put it onto my stories immediately so that you can constantly keep yourself up to date with what lenders are doing with the mortgage rates. But with swap rates on the way back down again, with the European Central Bank having made that first cut and the Bank of England meeting towards the end of June, and that lingering hope that we might see a base rate cut from them, there's every chance that we could see things all starting to move in a more positive direction, with rates gradually starting to come down. Now, of course, that's only the expectation. That's not guaranteed or set in stone. So we do have to monitor it very, very closely. In the meantime, if you are considering taking out a mortgage, especially if you've got a remortgage due within the next 3 to 6 months, what you should be doing is actually locking yourself into a rate right now. Because if things do still continue to go upwards from lenders, you're okay, you've got your rate secured. But if things do move in the direction we're hoping that they do, then that's fantastic news. We can move your rate also. So don't rest on your laurels. Don't sit on your hands and do nothing. Waiting is the worst thing you can do, as is burying your head in the sand. Take action, get in touch with a mortgage broker as soon as you possibly can, and make that move. Hopefully you found that useful. Take care.